Here's something that should bother you a little bit, mate. For more than 40 years, Australians have built entire retirement plans around one tax rule, and now the government's made the biggest changes to negative gearing we've seen in decades. The funny thing is, there's a pretty good chance you first heard about it in a group chat, saw a quick headline on social media, or someone mentioned it at work, but nobody actually explained what it means for you. So that's exactly what we're going to do today. Whether you're renting and hopping to buy your first home, you've already got an investment property, or you're thinking about becoming an investor one day, this is one of those changes that's worth understanding properly instead of just reacting to the headlines. Now, before we get into what's changing, let's make sure we're all talking about the same thing. Because honestly, half the arguments you see online about negative gearing happen because people don't even agree on what it actually is. So imagine you've bought an investment property. You've got your mortgage interest, maintenance, property management fees, council rates, and all the usual costs that come with owning the place. On the other side, you've got the rent coming in. In a lot of cases, especially during the first few years, those expenses end up being higher than the rental income, which means you're making a loss on paper. Under the rules we've had for decades, you can use that loss to reduce the amount of income tax you pay on your salary. So let's say you're earning $100,000 a year from your job and your investment property loses $10,000 during the year. Instead of paying tax on the full $100,000, you're only taxed as if you earned $90,000. That's basically what negative gearing is. It's been one of the most popular investment strategies in Australia because it lets your regular income help carry the property while you wait for it to grow in value over the long term, rather than relying on the rent alone to make money. Now here's where things start changing, mate. And this is the part you really want to pay attention to because the dates matter. From the 1st of July 2027, negative gearing will only apply to new residential builds. So if you buy an established property, meaning it's already been built and lived in before, and you purchase it after 7:30 p.m. on the 12th of May 2026, then once July 2027 arrives, you won't be able to use any losses from that property to reduce the tax on your salary anymore. Instead, those losses can only be used against rental income or capital gains from residential property. And if you don't have either of those in a particular year, the losses don't disappear. They simply carry forward until you can use them later. On the other hand, if you're buying an eligible new residential build, the existing negative gearing rules continue to apply, and at this stage there's no expiry date on that treatment. The only thing still being worked through is the exact definition of what officially qualifies as a new build, with more detailed guidance expected separately. One quick side note before we move on. If you're an SMSF trustee, this same legislation also bans new SMSF borrowing for residential property. That's a separate topic with its own details, so I've already covered that properly in another video here on the channel. For now, let's get back to what these negative gearing changes actually mean for most Australians. Now here's the bit that a lot of headlines have completely skipped over, mate. These changes actually affect fewer people than most think. If you already own an investment property, or you'd signed the contract before 7:30 p.m. on the 12th of May 2026, you're generally protected under what's called the grandfathering rules. In simple terms, nothing changes for that property as long as you continue to own it under those arrangements. So if you've been seeing people online saying negative gearing is basically gone for everyone, that's not really the full story. A massive number of existing investors won't see any change at all to the properties they already own, and that's an important detail that's been lost in a lot of the conversation. There is, however, one part of the legislation that's worth paying attention to, especially if you own an investment property with your partner. As the law currently stands, if a jointly owned property loses its grandfathered status because one owner passes away or the couple separates, that property can actually lose access to the old negative gearing rules altogether. It's estimated this could potentially affect around 680,000 jointly owned investment properties that were purchased before budget night. Now the government has already said it intends to fix this through another round of legislation later this year. But as things stand right now, that fix hasn't happened yet. So if you and your partner own an investment property together, it's definitely worth having a chat with your accountant rather than simply assuming the grandfathering rules will automatically protect you in every situation. Now, if you're thinking about buying an established property as an investment, there's something else worth knowing. There's effectively a transition period between now and the middle of 2027 where the current rules are still in place. The new restrictions only apply to properties purchased after the budget night cutoff, and they don't actually take effect until July 2027. So timing could make a real difference depending on your plans. And if you're looking at buying a brand new residential build instead of an established property, then these negative gearing changes don't really affect you at all, because eligible new builds continue under the existing rules. That naturally leads to the question, why did the government make this change in the first place? According to the government, the goal isn't simply to collect more tax. The idea is to stop the tax system from encouraging investors to compete over homes that already exist, because that pushes up prices without creating any extra housing. Instead, they want to encourage more investment into brand new housing, which actually increases supply. Now, whether that'll work exactly as planned is still up for debate. Plenty of economists disagree about how much impact it'll really have on house prices, and there are good arguments on both sides. But that's the thinking behind these reforms, and once you understand that, another major housing policy the government introduced starts to make a lot more sense as well. Because while everyone's been focused on negative gearing, there's another change that's been flying a bit under the radar, and for a lot of first home buyers, it's arguably the bigger deal. Back in October 2025, the government expanded the First Home Guarantee, which is the scheme that lets eligible buyers purchase a home with just a 5% deposit and avoid paying lenders' mortgage insurance because the government guarantees part of the loan to the lender. Under the old version of the scheme, there were income caps of $125,000 for singles and $200,000 for couples, plus there were only 35,000 places available each year. Well, all of that has now been removed. There are no income limits anymore, there's no annual cap on places, and the property price caps have increased significantly across many parts of the country, including up to $1.5 million in Sydney. For a lot of people, that could mean the difference between needing to save well over $200,000 for a deposit and getting into the market with something closer to $50,000. If you've been saving month after month thinking home ownership was still years away, this change alone could bring that timeline forward a lot sooner than you expected. Now, when you put these two policies side by side, you can actually see what the government's trying to achieve. On one hand, they're making it easier for first home buyers to purchase an existing home. On the other, they're making it less tax-effective for investors to compete for those same established properties while still encouraging investment into new residential builds. So rather than being two completely separate announcements, they're really part of the same housing strategy. So what does all this actually mean for you? Well, if you're a first home buyer, it's definitely worth taking another look at the First Home Guarantee, especially if you ruled yourself out previously because of the income limits or because you thought all the places were gone. The scheme today looks very different from what it did a year ago. If you're already an investor, you can probably breathe a little easier because, for most people, the properties they already own remain protected under the grandfathering rules. If you own jointly with a partner, though, it's worth checking that specific issue we talked about earlier with your accountant until the government finalizes the promised fix. And if you're thinking about becoming an investor for the first time, this is where planning really matters. Whether you buy an established property or a new build, and whether you buy before or after the middle of 2027, can lead to a very different tax outcome than it would have under the old system. That's not something you want to guess your way through. It's a conversation worth having with your broker or accountant before making any big decisions. And just a quick reminder, this isn't personal financial advice. Everyone's financial situation, goals, and circumstances are different, so think of this video as an explainer to help you understand the changes and ask the right questions, not as advice tailored specifically to you. At the end of the day, the biggest takeaway here is pretty simple, mate. These reforms are likely to reward the people who take the time to understand the details instead of reacting to the headlines, and they could catch out the people who don't realize what's changed until it's too late. So if you've got a mate who's renting and thinks buying a home is completely out of reach, or someone with an investment property who hasn't looked at their plans since before this year's budget, send this video their way. And now, I'm curious to hear from you. Now that you know what these changes actually mean, does it affect your plans at all, or were you already preparing for this? Let me know down in the comments.